All eyes were on Apple as we came back from our 3-day holiday weekend here in the United States. Yesterday, Apple said that they were likely to miss analysts' expectations in regards to sales and earnings as a result of a production slowdown with a lot of their factories over in China, which of course is the epicenter of the coronavirus. That pressured markets for most of the day. Interestingly enough, the NASDAQ actually finished flat, but the other markets were down. So we're going to see how all that affects our intermediate term posture. We'll then get into our trade application example today, which will also be on a technology-oriented stock, which is setting up with a nice bullish intermediate confirmation signal. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 18th. 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe while you're over there. Check out our little description area. Sign up for our email distribution list. Also, we're heavy users of Twitter. Make sure you're following me at the handle @BrandonVanZ. And thank you to everybody who clicks like and retweet on these Market Outlook related posts. Lastly, we have a presence on Facebook as well. Feel free to join our group at the web address embedded in the link and logo in front of you. All right, let's go ahead and jump into our charts. As you can see, I've got chart 4B pulled up here in front of us. This will give us a nice high-level overview of the four major U.S. equity indices. Gives us a sense of whether we have bullish or bearish postures by looking just merely at the background colors of the chart. So as an example, when we have the green background color behind today's candle on all four of our charts, it reminds us that we continue to have a bullish posture. So one day certainly does not make a trend. And as I mentioned in the intro, markets were largely lower today. The S&P 500 was down 0.29%. Dow Jones was down 0.56%. Russell 2000 was down 0.24%. The NASDAQ was kind of the odd man out there, actually finished slightly higher, up 0.02%. Regardless of pullbacks in 3 out of the 4 indices, we continue to have that strongly bullish intermediate term posture according to the market forecast technical indicator. Remember, what we're using for that is this green line in that market forecast indicator that you can find on the Thinkorswim platform. If the green line is in the upper reversal zone like it is on all 4 of our indices, actually hang tight on that thought. It's actually in the upper reversal zone on 3 out of the 4. The 4th one here, the Russell 2000, it's not quite in the upper reversal zone, but because it's trending higher between 50 and 80, we still consider that to be a strongly bullish posture. So we're in fairly good shape there. You can also see that in all 4 of our charts cases, we do have price above a rising moving average. We can also determine that fairly easily through our color-coded system by just looking at the color of the moving average, in this case that dark green, dark green, dark green, and dark green, and that will tell us that price is above a rising moving average. So generally speaking, we continue to be in a bullish trending market. Obviously, there are going to be times where stocks don't go up every single day, and you have to kind of deal with those moments along the way. But for the most part, I would say that this market has been handling all the fears out there, particularly with the coronavirus, in stride, and has continued to be in an upward ascent for the most part. So anyway, not necessarily the strongest of days on Wall Street, but nothing disastrous took place there at the same time. One thing I did want to point out that's kind of catching my eye that might be worth you keeping your eye on as well is it does look like we're setting up with a bit of a bearish divergence here. On the near-term line, notice that the near-term line kind of has lower highs and lower lows. Meanwhile, price is largely going higher during that span. So a little bit of a pressure on the internals there, kind of underneath the surface. But until we see a significant break below that rising moving average, I'm just going to put it in the interesting category, not necessarily actionable category. All right, let's go ahead and now move along to our next chart. And we'll do our 3 green arrows chart now. This will be chart 4D. And here you can see that the background colors of all 4 of our charts are green on this setup as well. And in this particular case, that means that we have 3 green arrows on each one of those 4 charts that we see right there. The 3 green arrow system is basically looking at the 30-day moving average. the MACD histogram and the stochastics to try to determine if the signals are currently bullish or bearish. If they're bullish, then a green arrow is plotted, and if you can get all three of them to be bullish at the same time, that's what presents our 3 green arrow strategy, and basically is a way for us to try to gauge whether right now is a good time to be thinking about trend trading or not. And it is, and I can certainly verify that just judging by the success of my trend trading portfolio that we have for my Monday top-down trend trading class. That has been, out of the 4 premium trading rooms that I teach in 2020, without a doubt, that has been the one that has just been crushing it to the upside. So this does feel like it's more of a trend trading environment, as long as you're in the right areas, and there is some debate as to where the best areas are. Strangely enough, utilities continue to be one of our best areas out there, and you don't necessarily think of utilities as a great trend trading product, but it certainly has been in 2020. So anyway, point is, we do have 3 green arrows across the board, so we have reasonably strong trend trading conditions at this moment in time as well. All right, moving along now to our next chart setup. Let's go on over here, take a look at our 1040 crossover chart. Not a whole lot to report here, because remember, this is not a chart where we expect change that would happen fairly regularly, right? Whenever we see changes here, it typically takes place over multiple months. So anyway, just be aware of where we stand. These are 3-year charts that you see in front of you. All 4 of our charts continue to have the green background color, telling us that the 10-period moving average, in this case is the 10-week moving average, is above the 40-week moving average, and therefore we have the so-called golden cross condition that continues to take place in this market. And quite frankly, the lines are separating as well. And remember, that's one thing you can judge by kind of looking at this purple line underneath the main charts. If that purple line is going up, like we see mostly here, you can really see it pronounced here in the NASDAQ and the S&P 500. When that purple line is going up, it means that the separation between the orange and the blue lines, which are the 10-period moving average and the 40-period moving average, are separating there. So there's basically more aggressive price action in the near term than what had occurred previously, and that is generally a sign of strength. A good bull market is currently intact. All right, moving right along now, let's go ahead and talk about some of our 12 grid analysis. So for that, let's come on over here to chart 5A and start with our asset class 12 grid. Remember, as we're looking at these, the background color will tell us whether we have a bullish or bearish intermediate term posture using the market forecast technical indicator. And then there are 2 different shades of both green and pink, whether you're talking about light pink versus dark pink, or light green versus dark green. They will all mean their own things there. So let's kind of have that conversation here. Let's talk about the pinks first. We only have 2 of them on the board, so that should be nice and quick. The first one is up there at the top. That's EFA. That's a way to gauge what's happening with foreign stocks from from developed countries. Think of Europe, Australia, Japan, etc. There you can see we have a pink background, and the reason for that is the intermediate line is at 65 and falling. So remember, if the intermediate line is between 80 and 50 and falling, it's considered weakly bearish, right? Even here you can see that, yeah, things haven't been going that great, but you'd probably hesitate calling this an out-and-out bearish looking chart, because price is still here kind of in the middle of the range over the last 3 months. Right now it's a little bit more bearish than bullish, which is why the background color is that lighter pink color. But obviously you don't want to get overly aggressive until you start seeing a more consistent downtrend in place here, unless you have a high confidence as to what the future holds. In terms of the other pink chart on the board down on the bottom, that's oil. In this case, notice the background color of the chart is a darker shade of pink, and that refers to the fact that this is considered to have a strongly bearish posture rather than a weakly bearish posture. Here, the reason that it's a strongly bearish posture is because the intermediate line is at 14 right now. Remember that the lower reversal zone on the market forecast starts at 20, so anything below 20 is considered strongly bearish. Now, if it starts rising above 20, at that point, you're going to actually see a posture shift to a light green background or weekly bullish. So that's one possibility here. We're going to keep our eye on it. You can see that oil has gone up for maybe call it 4 out of the last 5 days or so. So at least there's a start there. Now, obviously, we're still in a pretty significant downtrend over the last couple of months, so we don't want to trust it too much. Most of the time that people have trusted oil and gas related investments in the last 2 or 3 years, they've walked away heartbroken eventually. So we've got to be careful there. But at least it's a start. We did have a lot of those oversold cluster signals piling up here on USO, and now we're starting to get some of that reversion to the mean. So perhaps an opportunity for it to stabilize and carve out a bottom. But until we see an actual uptrend take hold in oil, it's going to be hard to trust it. So right now it continues to have strongly bearish posture. If it were to emerge above 20 on the intermediate line, then at that point we'll start looking at a weekly bullish posture. All right, in terms of some of the other charts on the board, there's only one of these charts that has the light green shade for me to kind of explain that aspect. Remember, a light green shading, in this case it's for TNX, which is the 10-year U.S. Treasury yield, occurs when that intermediate line is rising between 20 and 50. And as you can see here, it just barely made that qualification. The intermediate line is at 20.34 and rising. So if it were at 19.99, it would look like this chart to the left, a dark pink color. But because it was able to get up and above 20 just barely for today at least, we have a weekly bullish posture. But again, I don't know how much I'm trusting that chart. So you can see that ever since this kind of breakdown that we had here near the beginning of the year, we've spent the rest of that time below a falling moving average. So at this point, I have no reason to believe that TNX is going to start surging at these levels. Remember that has an impact on a lot of other assets, including the chart directly above it, which is real estate investment trusts. In this particular case, this is VNQ, the Vanguard version of real estate in terms of their ETF. And you can see that that has been a stellar chart. That's been a really, really nice looking move that we've had on VNQ here over the last couple of months. And that's a direct result of interest rates falling. Interest rates fall, REITs go up. If the opposite starts happening, so that is one reason why we want to keep our eye on TNX. If this weekly bullish posture is perhaps a signal of sorts that things are going to start changing, then perhaps you start lightening up your position on VNQ. But I'll say the same thing, which is until this breaks down below its moving average, I'm going to assume that VNQ remains in an uptrend. And until TNX breaks above its moving average, I'm going to assume that it's going to continue to be somewhat weak. So anyway, some interesting looking charts here today. One other one before we move to our next set of 12 grids. I think there should be a mention here about gold. This is actually a really nice looking breakout here on gold, and I saw some folks tweeting about the gold mining stocks today, but it wasn't until just now that I noticed that GLD itself looks really, really strong here. So there might be something to this, and I don't really see a whole lot of people talking about it. I mean, there's plenty of gold bugs out there, don't get me wrong, but just in the mainstream media, it seems like they kind of have more of an emphasis on things like Apple here today, and they haven't really been talking about gold so much. But that's a beautiful looking bounce off of a rising moving average up to new multi-month highs. So there could very well be some nice bullish setups in gold mining areas, or even if you're just using GLD as your proxy for the price of gold itself. So I think that definitely is a chart we want to keep our eye on there. It's a really nice looking bounce there. All right, let's go ahead and pop on over here to chart 5C, which is the U.S. sectors now. Try to get a sense of what's been happening from a sector perspective here in the United States. Now remember, each one of these ETFs are those select sector spider funds that track the 11 different sectors that make up the S&P 500. So there's definitely more of a big stock bias to these companies. These don't include small cap companies, but still gives us a nice liquid way to try to get a good sense of what's happening from a sector to sector basis. And as you can see here, it's a clean sweep. In other words, every single one of these charts on the board is green. Now, some of the charts are going to look better than others, but for the most part, this supports the notion that the United States stock market is in a very strong bull move right now, because really all sectors are helping participate to a degree in that move. Now, the one that is the weakest link is, no surprise, all the way off to the right-hand side here, you've got a lighter green background color on energy. So we have a weakly bullish posture there, whereas all the rest of the charts are strongly bullish. And that makes sense. You look at this chart for XLE, and yeah, it's great that it was able to bounce a little bit, but we're still, struggling to get back above that moving average there. So that's by far and away the weakest one here. But when it comes to what are the strongest ones, it's kind of hard to judge for certain. I would say that communications looks good as we broke out above a multi-month high here. Communication stocks are up about 10% over the last 3 months. Technology continues to be strong. You can see technology is up about 16% over the last 3 months. And then as you start looking at some of these charts down here towards the bottom, the interest rate sensitive charts, those look good as well. Take a look at utilities here. I mean, that is just phenomenal right there. Utilities are up 12.7% in the last 3 months. And look at just the last 4 days. I mean, it is quite remarkable here. So I know that's one area that my students in my Monday top-down trend trading class are applauding, since that is our biggest area as far as components from a sector perspective. We have, I think, 6 out of our 25 holdings in the utility space, and that has been the case all year long. So we've benefited from that entire move out of utilities there. It is certainly a surprise move. We weren't anticipating that type of a move, but sometimes you get lucky in this business, I suppose. You can also see over here to the right of utilities, real estate looks somewhat similar. Now, the returns are not quite as good. Notice that real estate is only up about 8% as opposed to the 12% for utilities over the last 3 months. But nonetheless, that's a very nice surge off of those rising moving averages there for those interest rate sensitive areas. While we're on the topic of sectors, let's kind of transition our thoughts here for a second on over to the internet, and wanted to show you what the sector selector rankings look like. Now, I didn't create the bottom portion of this sector selector for those of you that are premium members wondering where that is. With it being a holiday weekend, remember that this graphic is mostly used for my Monday top-down trend trading class, so there wasn't a need for me to put it together since we didn't have class yesterday with the President's Day holiday. But I did put together the upper half of the rankings here just to give us a sense from a high-level perspective if there were any changes taking place, and there really wasn't a whole lot to report. We had technology, utilities, communications in the number 1, number 2, number 3 slots yet again, and that's the 4th week in a row that they shared those exact same 3 slots. So the strong continue to be strong, and likewise the weak continue to be weak. You'll notice that industrials, materials, and energy finished 9, 10, and 11 for the 3rd straight week in those cases there. Where we had some shakeup was in the middle. Real estate was one of the stars as it emerged out there to number 4. In fact, I think I foreshadowed that to a degree when I was doing this video last week. I said after seeing those moves in real estate last week, I would not be surprised to see real estate move up in the rankings when I did them over the weekend, and sure enough, that's exactly what happened there. Who was the victim of that move? In this case, it might have been shared between healthcare and staples. Both of those fell on a relative basis. So anyway, not a whole lot of change there. The strong ones continue to be strong, and the weak ones continue to be weak on a relative basis. Also, while we're over here, let's see how you guys did on the likes the last time I did the video, which would have been on the 13th. Remember, if you want to help support this video, one of David and I's favorite ways for you to do that is to click like for us. If you have a Twitter account, remember that we pin it to the top of our timeline after we do the video to make it nice and easy for you to find. Otherwise, you can use this widget that's embedded directly into our website if you're watching it over at marketscholars.com. Just click that little heart button right there, and as you can see, 103 of you did that for me last time around. So let's make sure that this is a full-length video. And I'll do the same thing that I've been doing for you. If you want me to do a full-length video when I do this video again on Thursday, go ahead and click like, because that will add to the 100 people that could possibly do that. If you do not want me to do a full-length video, if you want me to do an abbreviated 15-minute video, then do not click like. So I'll let you guys vote on that. All right, let's go ahead and get back on over here to our charts and take a look at some more 12-grid analysis by popping on over here to, let's do the global stocks primary grid, and this will be chart 5E. Now remember, one of the stories that has been kind of emerging here in the last several weeks is the strength in U.S. stocks in relationship to the rest of the world. It's not that all areas of the world are doing horribly. It's just that on average, the United States has done better. And this time when we're looking at this first set of 12 grids here, things are looking a little bit better than they were when we took a look at these last week. So that's at least a promising sign, but there's still a lot of ugliness on this chart. One that stands out to me immediately is Japan. I mean, holy mackerel. Japan just fell off of the map here in the last couple of sessions. Notice that we touched 3-month lows on Japan with today's big plunge. We were down 1.49% on EWJ today. So, you know, Japan, for it being a smaller country, is still a very prominent financial center. So to see it starting to deteriorate this way is a little bit concerning. We'll have to keep our eye on that story because, you know, again, we're hitting multi-month lows there. And while India is not looking quite as bad as Japan, it shares that dark red or dark pink background color telling us that we have a strongly bearish posture there. And India may not be as important as Japan in the financial markets, but from a population center, India, of course, is going to be one of the most important areas of the world, not only today, but going forward. So we want to keep our eye on that as well. Both of those look like their stock markets are struggling to a degree and in a series of lower highs and lower lows at this point. So not necessarily anything good developing there. On the other hand, I do like the action that I'm seeing out of Italy here. Notice that Italy has that dark green background color, so it shares that with the United States in the upper left there. So Italy, EWI, actually closed at a 3-month high here today. It didn't hit a 3-month high on an intraday basis. You had that kind of funky looking candle right there on February 10th. But the closing price here today was higher than those other candles along the way. So not a whole lot of people talking about Italy out there, but that does appear to be one of the stronger looking foreign markets here from a major economy's perspective. Let's take a look at what some of the some of the secondary economies look like now. So for that, I'm going to come on over here and take a look at 5G. All right, so as these load up here, you can see a mix of charts from this perspective as well. Some green, some pink, some look better than others. Taiwan, down below here, looks like it's setting up as a downward push candidate for those of you that are looking for bearish trades. That's EWT, so kind of following along in Japan's footsteps there to a degree. Remember, a lot of those Asian nations are very important when it comes to technology, semiconductors, and exporting in general. So that theme has kind of been tied up to a degree with everything that's going on with the coronavirus. So anyway, Taiwan looking a little bit weak right here more recently. You can also see from kind of a more bullish perspective that Switzerland remains resilient. I wouldn't say that it's necessarily rocketing higher or anything like that, but the fact that it's maintaining its strength up here near these elevated levels on EWL is noteworthy. So good looking chart there out of Switzerland. Spain had a pretty decent move, so sometimes Spain and Italy are kind of lumped together as, you know, not necessarily the most important European nations, but in that next tier lower than that. So you can see that Spain is up here near some of its 3-month highs as well. And Mexico is doing a reasonably good job of kind of holding the line there as well. So I guess the key takeaway is the United States continues to be a leader from a worldwide perspective with the stock market, but there's a couple of other charts out there that are at least vying for consideration. All right, let's go ahead and now talk about our trade application example for today. And I wanted to bring up, first of all, let's go over here to chart 4A. This is just our normal market forecast view. This is just the one grid as opposed to the four grid that I typically start off our session with. And I wanted to pull up LRCX. This is Lam Research. And remember that today we saw the NASDAQ basically finish flat. We also saw that the technology sector remains the strongest sector, not only from a 3-month price performance basis, but its technology also remains number 1 on the sector Selector ranking system that I put out over the weekend as well. So if you're looking for kind of stronger charts that are out there, perhaps looking in some of those technology-oriented areas like semiconductor and semiconductor equipment could make some sense. So Lam Research caught my eye today. First of all, it was down. A lot of those semiconductors were down today as a result of what Apple was mentioning. But the question is, does that, open up an opportunity? Now, obviously, everybody's going to walk away with a different answer there. But if you have the general mindset that a trend in motion tends to stay in motion, then I think a lot of you would probably look at this chart and say, yes, this is still an uptrend here. Yes, it was a rough day for Lam Research shareholders, but there is not any major broken support areas. This stock is still trading above a rising 30-day moving average. And despite today's 4% pullback, this stock is still up 18% over the last 3 months. So in fact, all of our time periods up here on the top labels are still green, telling us that it's strong in multiple time periods. So what caught my eye and why I wanted to bring it up in this particular presentation today is because there is a market forecast signal that's taking place here on this particular chart. And that market forecast signal is called the bullish intermediate confirmation signal. Now, some of you are familiar with that concept because David and I try to point them out whenever they do exist on our major indices out there. But some of you might not have known that you can also apply the same concept to individual stocks like LRCX. So what you're going to do, it's kind of a two-part process to evaluate whether you have a bullish intermediate confirmation signal. And remember, a bullish intermediate confirmation signal is effectively a buy the dips mentality. So first part of that bullish intermediate confirmation signal is the words bullish intermediate. So the first thing we want to do is determine if the intermediate line, which remember is the green line on the market forecast down below, is that considered bullish? Well, remember, anytime that green line is in the upper reversal zone, like this one is right now above 80, we consider that to be strongly bullish. So, that's the first thing, is identify whether you have a bullish intermediate trend. Remember, the buy the dips mentality is also based off of a concept of a prior uptrend in place. Well, clearly we have an uptrend in place and we have a bullish posture. You combine that with the second part of the bullish intermediate confirmation signal, which is having the red line in the lower reversal zone. In this case, the red line needs to be below 20. And as you can see, that is the case right here. The momentum line is at basically 10.98. Now, those are the two things that qualify a bullish intermediate confirmation signal. So we could really stop there. But a lot of times you hear David and I talk about this concept that there are more ideal signals and less ideal signals. And you can use some of these lines to try to gauge whether you have a more ideal setup. And this one might very well be considered a more ideal setup. And the reason I say that is because the blue line in this case is between 50 and 20. Remember, if the blue line were up here at 75, it doesn't give you an impression that it actually sold off enough for you to consider a buy the dips mentality. This is a legitimate pullback here in this uptrend. This is a 4% pullback here today. So that was enough to push that blue line here between 50 and 20. So there was enough of an exhale for you to kind of consider to reload the gun to the upside if you assume that this trend continues to hold to the upside. So that's a benefit. The other benefit is that the red line is not at an extreme level. Sometimes when that red line gets below 5, it's telling you that it's too much of an exhale, and there's a trend change that could be on the horizon. So we're a little bit more nervous around those. In this case, it's not down there below 5. It's still between 5 and 20. It's at basically 11 at this point. So this would be an example of a more ideal. None of these examples will ever guarantee a win, of course. That's technical analysis for you. But for those of you that were wondering what a more ideal setup would look like, this could very well be considered one of those. So in order to kind of facilitate that idea, I'm going to come on over here to the trade tab. I've got what's known as a bull put spread pulled up down below. And what I'm doing is I'm using the March contracts here with 31 days left until expiration. And I'm selling the 310 put. And at the same time, I'm buying the 305 put. That's creating a credit of $1.34. And if you do the numbers, run the math, that is over a 30% return on risk, which is oftentimes what we shoot for when we're doing these types of setups. Now, one of the things I liked about where these strikes were placed is we're selling the 310 put. If you look at the chart, 310 is right here at that rising moving average, which would be another excuse for this chart to bounce if it doesn't bounce immediately. If it continues to come down here, our trade might be bailed out by having that rising moving average act as a launching pad, kind of like it did back in this general area over here as well. So I'm going to go ahead and click confirm and send that in and see if we can get filled first thing in the morning. All right, well, thank you for joining me here yet again tonight. Of course, the story of the day was Apple, kind of put a wet blanket on the rally to a degree, but for the most part, our posture remains bullish in most of our indices out there, so we're still looking for those bullish trade setups, including some of those oversold areas that I mentioned during the video tonight. If you got value out of the video, please click like for me over there on Twitter, and remember, David will be back with you tomorrow. Until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.